Welcome to this explainer. Today we are unpacking a really fascinating, highly structured blueprint designed to completely transform a modest portfolio into a mechanical wealth engine. We're going to explore the intersection of Bitcoin's macroeconomic bull case and what's called a rigorously designed thermodynamic investment architecture. Let's just break down how this structured capital allocation actually works in the real world.
Our journey kicks off with the central manifesto of this whole architecture. Get this. Cash is trash, cash flow is king. Volatility equals cash flow. The philosophy here literally flips traditional investing completely on its head. The core idea is that we don't try to time markets because, let's be honest, timing markets is a fool's errand. Instead, we harvest them. We don't sell off our high-conviction assets, we actually fund those convictions by systematically capturing the volatility surrounding them.
So, that naturally brings us to the big question. How exactly do you build a thermodynamic wealth engine? Now, in this context, thermodynamic just means treating market volatility like heat or energy, basically capturing that market chaos to power your portfolio. We're talking about engineering a behaviorally robust framework, something that actually allows you to navigate the intensely volatile swings of the crypto market without succumbing to human panic when things drop or irrational greed when things spike. It's about building a machine that runs on pure logic and math.
All right, let's dive into the core framework, the chessboard. This maps out daily investing across different phases, from highly illiquid, vapor assets all the way down to yield-generating plasma. Moving from left to right, we see the pieces, from pawns to the king. It's a really brilliant mental model that categorizes every single asset by its cash flow velocity and its strategic importance to the overall portfolio.
Moving right along to Section 1, the foundation, the plasma yield engine.
This engine's entire purpose is to solve the ultimate behavioral trap that destroys most retail investors, the emotional toll of massive market drawdowns. Because think about it, if you're getting paid while the market bleeds, you don't panic sell. 22.4% of this specific portfolio is dedicated to the plasma engine. By clustering income-generating assets in yield-focused ETFs, this engine converts market entropy into a daily automated cash flow. Right now, that translates to about $335 a month, which generates a 14.3% yield on the overall portfolio. It's the lifeblood that funds absolutely everything else.
Okay, Section 2, the Flywheel, the iceberg in corporate strategy. Now, right at the center of this strategy is a corporate fiat to Bitcoin recycling loop, primarily driven by MicroStrategy. The flywheel is elegantly simple in theory. Issue paper, like equity or convertible notes, use those proceeds to buy Bitcoin. Let the underlying Bitcoin appreciate so the net asset value of the company expands, and then issue even cheaper paper to buy more. It's a self-reinforcing loop that has effectively doubled the amount of Bitcoin per share for its holders over time. It's basically a perpetual accumulation machine.
When we pull back and look at the total allocation, the structure is incredibly deliberate. We've got 36.5% in the strategy iceberg, 22.4% in the plasma yield engine, and the rest spread across other assets. But here is the real secret sauce. 99.1% of this entire architecture is housed inside tax-advantaged accounts like Roth IRAs and HSAs. That means this modest five-figure portfolio is infinitely scalable. Every single dollar of growth and every drop of yield compounds without the friction of taxes slowing it down.
Now, to be completely objective here, we have to talk about concentration risk. Putting 36.5% into one corporate complex? Yeah, that's aggressive. If Bitcoin crashes 60%, heavily leveraged instruments tied to it can easily drop 70 to 80%. There's also single-issue credit risk to consider. But the data shows this isn't some blind gamble. It's a calculated thermodynamic machine where the operator accepts this localized volatility simply because the plasma engine below it just keeps printing cash to buy the dip.
Which brings us to Section 3, the crown, the Bitcoin king.
Now, what's really interesting about this specific portfolio snapshot is that it actually reveals a vulnerability. Currently, direct, unencumbered Bitcoin exposure is effectively zero. It's an architectural gap in this specific build. The user holds plenty of indirect exposure through miners and leveraged proxies, but the absolute cleanest expression of the thesis, spot Bitcoin in self-custody or liquid ETFs, is the missing king piece needed to truly complete the board.
And the scale of why that king piece matters, it's honestly cinematic. The macroeconomic thesis here projects a massive S-curve adoption trajectory. The target? Bitcoin capturing 25% of gold's investable market cap. By the time it reaches that threshold, we are looking at a fundamental structural shift in global finance. transitioning toward a highly verified, multi-planetary digital asset.
And that target isn't just built on hype, it is backed by a deterministic physical floor. 3,353 gigajoules. That is the actual thermodynamic work practically stored in every single coin, supported by a global hash rate that has been pushing toward 1 zettahash. That is an unfathomable amount of processing power securing the network. As the energy required to mine a single Bitcoin mathematically increases, the floor of marginal production cost rises right along with it. It is quite literally stored energy.
All right, Section 4, the proof, surviving all market regimes.
So, to see if all this actually survives contact with reality, we look at a direct comparison modeled out over a rigorous 5-year horizon. On one side, we have Strategy A, the architect keeping the plasma engine running and using its yield to aggressively dollar-cost average into Bitcoin. On the other side, Strategy B, liquidating the yield engine and just buying spot Bitcoin to hold. Strategy B is the ultimate behavioral trap. If spot prices drop 65%, human nature practically guarantees the naive investor will just stop contributing. Strategy A removes the human entirely.
Well, the numbers really do speak for themselves here. In a 1,000-path Monte Carlo probability simulation, across 3 explicit market regimes, the architect's yield recycling engine mathematically outperforms. It beats the spot-only strategy by over $6,000 in a bull market, by over $7,100 in a sideways null market, and by roughly $5,500 in a brutal bear market. The constant mechanical influx of cash flow simply overpowers the passive holding strategy every time.
And this brings us to what I think is a totally counterintuitive stroke of genius. Think about the sheer volume of Bitcoin accumulated here. The engine actually forces the user to accumulate the maximum amount of Bitcoin precisely during brutal bear markets. When the price crashes to its absolute lowest, the yield engine's fixed cash flow buys exponentially more units of Bitcoin. It literally turns crypto winters into massive accumulation events.
But listen, every system has a vulnerability, right? And it's vital we look at it impartially. When could this strategy fail? The answer is a scenario called the boring bull. If Bitcoin matures to the point where its volatility completely collapses, meaning the plasma engine's premium harvest just dries up, and spot prices simultaneously rip upward, well, the strategy loses its edge. In that specific world, holding simple spot Bitcoin wins.
Finally, Section 5, the ultimate cosmic vision. So, what is all of this perfectly architected thermodynamic wealth actually for at the end of the day? It's about connecting the rigorous math to a profound purpose. For the architect of this portfolio, the end game is explicitly mapped out, funding a $56,000 Digitarium mobile planetarium for educational purposes. It treats Bitcoin not just as some speculative tech stock, but as the foundational, multi-planetary money of the future. We're talking about wealth engineered today to fund the tangible expansion of human knowledge and lunar colonies tomorrow.
Which leaves us with this final, provocative thought. You've seen the data, the structures, and the mathematical defense against human emotion. The volatility of the digital asset space is entirely inevitable. So the question is, will you be a victim of market entropy, tossed around by fear and greed, or will you step up and become the architect of your own thermodynamic wealth engine? Thanks for joining me on this explainer, and I really hope it inspired you to take calculated, structured control of your own portfolio.